Welcome to our session on insider reporting, Beyond the Basics. As a general reminder, the following information is intended only as general introductory information to address some common questions, and it is not intended to be and must not be relied on as legal advice. Please refer to the specific provisions of Alberta Securities law. We encourage you to seek legal advice from legal counsel familiar with Alberta Securities law. All insider information, company names, and details used in this video are fictional. This video is intended for those who have been identified as a reporting insider, have a SEDI profile, and a basic knowledge of their reporting obligations. If you're looking for more information about insider reporting, such as what it is and who qualifies as a reporting insider, or how to get started on the SEDI system, please watch our Insider Reporting the Basics video. And reporting issuers can review our video, Insider Reporting Basics for Reporting Issuers, which focuses on the reporting required or permitted by reporting issuers in relation to insider reporting. The videos in this series can be found in the Issuer and Insider Toolkit located on our website, asc.ca. We will start with a brief overview of some of the reporting exemptions under NI 55-104. Then we'll walk through how to file some frequently asked about insider reports and wrap up with a few helpful tips. There are some exemptions from insider reporting requirements or reporting deadlines as set out in NI 55-104. We provide some examples, but caution that this is only a summary. The full text can be found in parts 5 through 9 of NI 55-104. You should review the exemptions in detail and may wish to seek legal advice to ensure that you are able to rely on the exemptions in your specific circumstances. Some of the exemptions include Part 5 of the instrument, which contains an exemption for securities purchased under an automatic securities purchase plan that, generally speaking, allows reporting in respect of those purchases to be done by March 31st of the following calendar year, rather than by the normal 5-day deadline for insider reporting. And Part 6 of the instrument speaks to an exemption for issuer grant reports. This part applies to situations where an issuer has granted securities under a compensation arrangement, such as options, stock appreciation rights, restricted share units or restricted shares, deferred share units or performance units. Some issuers may choose to file an issuer grant report on SEDI that publicly discloses the details of acquisitions of a security of the reporting issuer under a compensation agreement made to reporting insiders. If an issuer has filed an issuer grant report within 5 days of the grant, then the reporting insiders named in the issuer grant report will have more time to file. Instead of reporting the grant within the usual 5 days, the reporting insiders have until March 31st of the next calendar year to report the grant or award. However, if subsequent to the grant and prior to March 31st of the next calendar year, you dispose of the options or awards identified in the issuer grant report, you must file a report for the grant and the disposition within 5 days of the disposition. You are not able to wait until March 31st. Reporting issuers are not required to file an issuer grant report, so we caution reporting insiders to confirm that the issuer did in fact file an issuer grant report that included their grant and that it was filed by the issuer within 5 days of the grant. If the issuer did not opt to file an issuer grant report, or if it was not filed on time, then the reporting insider is subject to the normal 5-day filing deadline, and if they miss it, they will be assessed a late fee. Part 8 provides for an extension to the filing deadline that applies to an issuer event. An issuer event refers to a stock dividend, stock split, consolidation, corporate amalgamation, reorganization, merger, or similar event that affects all of the holdings of a class of an issuer's securities in the same manner on a per security basis. Reporting insiders affected by an issuer event are required to report the effect of these changes, but do not need to do so until the next time they file an insider report. For example, if you are a reporting insider of an issuer who has recently completed a share consolidation, you may choose to wait until the next time you have to report an acquisition of shares or similar transaction relating to the securities of the issuer, and then report the consolidation transaction at that time. Share consolidations or splits are considered an issuer event as discussed previously and are included in the exemption in Part 8 of NI 55-104. These types of transactions are infrequent and reporting insiders may be unsure how to file them correctly. We've outlined a couple of examples to illustrate when and how to use this option. So if the issuer event is a consolidation of shares, let's say a 4-to-1 consolidation, and the insider currently holds 100 shares, we would divide the total by 4, so after the consolidation, the insider would hold 25 shares. The reporting insider would be required to report the transaction disposing of the 75 shares using Code 37, stock, split, or consolidation, to adjust their balance to 25. If the issuer event is a share split, using a 4-to-1 split scenario, we would then multiply the 100 shares by 4, and after the split, the insider would hold 400 shares. The reporting insider would be required to file a transaction acquiring the additional 300 shares using Code 37, stock, split, or consolidation, to adjust the balance to 400. The same logic would be applied to each ownership type and security on the insider's profile for that issuer. For example, if they hold shares directly, indirectly, such as in an RSP account, or have control over an account, a report would be filed for each ownership type separately to reflect the resulting holdings. Additionally, if they hold options or warrants, they may also be affected by the event and require a report to be filed. In that case, the report would reflect both the change in the number of securities and the exercise price. We are often asked how to report change of holdings when insiders have moved their holdings between ownership types. If you are a reporting insider and you transfer securities from a non-registered investment account into a registered account, such as an RSP or TFSA, you are required to report that change in ownership type. Reporting a movement from direct holdings to, let's say, indirect holding accounts, such as an RSP, or to an account that you have control over, such as a spouse's trading account, the movement would be reported as a decrease in the account that you are moving the shares from, and an increase to the account that you are moving the shares to, using transaction code 90, change in nature of ownership. Please avoid using codes such as 97, other, or 99, correction of information. If the transaction was reported using an incorrect ownership type, then the transaction should be amended to reflect the correct ownership type. Insider-defined securities are securities that are created by the insider and reflected by the insider on their insider profile. They are not found in the list of issuer-defined securities. As an example of this, if an insider granted a third party an option to acquire their securities, or if the insider acquired a call option that trades on an exchange or over the counter. In most situations, insiders are required to add an insider-defined security designation when filing the acquisition of a third-party derivative. Third-party derivatives are securities issued by a person or a company other than the issuer. The price of a third-party derivative is based on an underlying interest, such as common shares, issued by the issuer as an underlying security. Third-party derivatives include exchange-traded call or put options, over-the-counter OTC calls, or put options, including private options to purchase or sell, equity swaps, long or short positions, forward purchases or sales, and futures contracts, long or short positions. It may also be necessary to create an insider-defined security when the issuer has failed to reflect an issuer-defined security on its profile. These circumstances should be rare, as issuers are required to properly reflect all securities it has issued. However, on a rare occasion, insiders may need to add an insider-defined security designation. For example, an insider may be required to add an insider-defined security if the issuer has not added an issuer-defined security to its outstanding security list, for example, stock options. In this situation, insiders or agents should contact the issuer first and request that the issuer add the security designation to its profile supplement. However, if the issuer fails to do so on a timely basis, the insider may need to add an insider-defined security in order that they can file on time and avoid filing late and incurring a late filing fee. One of the more common transactions is the reporting of securities that are exchangeable or convertible into common shares. These transactions are required to be reported as a two-sided transaction. This means that the first report is filed for the security designation options, reporting the exercise of the options. This has the effect of decreasing the balance for the number of options held. As we see here, 50 options are shown in the number or value of securities disposed of in the box on the right on the screen. In the next screen, we will look at the second side of the transaction. The second part of the transaction is to report the securities acquired on the exercise. In this case, options exercised into common shares, so the filer needs to report common shares acquired and the resulting increase in the holding of common shares. When presented with the security designation, the filer would select common shares and proceed to record that the reporting insider had acquired 50 shares, as we see here. In the field for the nature of transaction, the code would be 51, exercise of options, to show how the shares were acquired. There can be other scenarios when reporting may vary from the previous instance. For example, if the issuer's share option plan allows for the surrender of options for cash, then only one report would be filed under the option security designation showing the decrease using transaction code 59, exercise for cash. There are other instances where our example of an exercise of option may require additional reports. For example, if the reporting insider sells common shares that were acquired through the exercise of options, an additional report would be required. After filing the report for the option exercise, as noted earlier, which reflected the increase to the common shares, a subsequent report must be filed to disclose the sale or decrease in common shares using the transaction code that best describes how the sale was executed. For example, it could be an acquisition or disposition in the market, which would be a transaction code 10, or transaction code 11 if it was carried out privately. Similarly, if the options are exercised and the resulting common shares are transferred to another person or entity, such as a family trust or a holding company, this would also require a report. First, the options must be exercised, resulting in the increase in common shares to the original option holder, and then another transaction must be reported to reflect the decrease in the insider's common share holdings using the transaction code that corresponds to the nature of the transfer, such as Code 11, which is an acquisition or disposition carried out privately, or 47, which is an acquisition or disposition by gift. If the reporting insider would like to move the security received from the exercise of a stock option to a different ownership type, such as an RSP or a TFSA, then after completing the steps to record the option exercise, a separate report must also be filed under that holder to reflect the transfer to the new ownership type using Nature of Transaction Code 90, change in nature of ownership. When a repricing of the exercise price of an issuer's options occur, We often see insiders reporting the change by amending the exercise price on the existing transaction. Repricing of options should be treated as a grant of a new option and reported in two transactions. First, they should show the disposition of the cancelled option by using code 38, and then an acquisition for the grant of the new options with the new exercise price using code 50. The general remarks field should be utilized to explain that the options were repriced and to provide any additional information related to the repricing of the options. As we come to the end of the third and final video of this series, we'd like to leave you with a few common areas where we frequently see errors in filings. First of all, the transaction codes. There is a list of preset nature of transaction codes to select from when filing reports. The codes assist the market and regulators to understand the circumstances surrounding the acquisition or disposition of securities. Sometimes reports are filed using incorrect nature codes, and it is important to use correct codes in order that the market understands the transaction. For example, if a report was filed using transaction code 16, which is an acquisition or disposition under a prospectus exemption, but actually was a market purchase, it could be confusing if the issuer's disclosure did not mention that they were raising funds using a prospectus exemption. A link to all of the available nature of transaction codes is available in the resource section of the Issuer and Insider Toolkit on our website, asc.ca. We also encourage you to double-check dates. When entering the date of a transaction, sometimes filers will transpose the month and day if the dates are entered manually. If the transaction date is not correct and is outside of the filing deadline, the insider could be assessed a late fee. The system does provide a calendar icon to the right of the date field, and it is a helpful tool which can be used to aid filers in selecting the dates rather than entering manually. We also encourage filers and insiders to review and verify reports after submission to SEDI to ensure that the report was received and that all of the details are correct. If the report contains errors, more information on amending a report can be found in our video, Insider Reporting, the Basics, or at the SEDI Online Help. Section 2.14 of National Instrument 55-102 states that the insider should not file more than one insider profile on SEDI. If you have a duplicate insider profile, you should promptly take steps to delete it. You will need to choose one profile that will continue to be used going forward. Any transactions filed on the duplicate profile or profiles that will be deleted will need to be refiled under the chosen profile and deleted from the duplicate profile. In advance of any corrections, please contact the SEDI service desk or the securities regulator, that is the principal regulator for the issuer, and advise them that you are correcting a duplicate insider profile. To delete the duplicate profile, you will need to contact the SEDI service desk. You will be provided with an insider profile deletion request form to be signed by the insider and returned. You will be advised of the appropriate steps to follow to correct the current profile and delete the duplicate profile. That brings us to the end of the topics for this video. We would like to thank you for your time and attention. We have compiled a list of links referred to in the presentation that may be of assistance in your insider reporting. These links are available by searching our website at asc.ca, the SEDI website at sedi.ca, or the CSA website at securities-administrators.ca. Thank you again for your time. We leave you with the contact information for the CSA service desk and our inquiries line should you require any further assistance.